Hi, David Roach, oil prices. It's likely the prices per barrel of oil, taking Brent as the benchmark, will be US dollars 120 this year, rising to US dollars 140 next year. That's way out of the consensus, but I want to go through my reasoning for thinking that will be the case, and why, therefore, the pressure from oil prices on inflation will not go away, but revive to some degree, though it won't stop central banks going on hold. Now, my way of analyzing the oil prices, supply and demand, boring as it may be, I think it is that rather than speculators, which will set the level. Let's start with demand. The most significant boost to demand this year will be China reopening. That can boost global oil demand growth by up to 40%. The reason for that is not because China has reformed, or that the defects, structural defects of the Chinese economy, such as over leverage and bad debts, the household bubble, shadow finance, and I can go on. It's not because these have been fixed. It's because rules like the 3 red lines intended to cut the leverage in shadow banking and in real estate developer debts, they've been abandoned. So rather than fixed, they've been abandoned. But the result is that together with the abandonment of zero COVID, growth and demand for energy will rise. Now, what that actually reflects is the fact that if people are no longer locked down, they will move around. If they move around, they're going to take the bus or the metro or the plane or the train or ride in the back of a truck. They will also shop, which means that the stuff they shop for has to be moved in a truck or on a train or on a plane. So the result of the growth in demand from China, which adds the biggest single slice to growth in world oil prices, the result is transport demand for fuel, not as a result of solving China's problems, but simply as a result of removing lockdowns and giving up on the zero COVID policy. The second driver, of course, is that the world is going to avoid recession. The reason for that is partly regional. Japan doesn't even know there's a risk of recession out there, so it'll just motor on at its low structural growth rate of 1.5%, 2.5%. China won't tell you if there is a recession because it's politically incorrect, so there won't be one, and there will be a revival in demand. And when you come to Europe, it looks like you're going to have a long, low, protracted recession. But all in all, if you look at the whole of the world together, like one beautifully rounded egg, what you find is that the world should have had a recession last year because real wages plummeted and the place looked a mess and there was nothing to be optimistic about. So you did not have a recession because the balance sheet of the world contained huge amounts of savings, which were transferred to the government during COVID, which got spent last year. So essentially you had an economic recovery of sorts, or at least sustained economic growth on a worldwide basis, because its balance sheets were spent. Next year, things change around. For a start, you'll have fiscal stimulus for households in the United States, which is quite substantial. But most of all, we're going to see headline inflation fall. Wages, which were agreed last year, are going to come through, and they will come through at rates in advance of inflation. So there will be real income gains, which will be spent. So this year, you have a world which manages to stagger along at a low growth rate, but a much higher growth rate. Recovery in demand for energy is simply because it is driven not by the balance sheet as last year, but by the income statement. Now, let us then turn to supply. The first and most critical thing in the supply picture is that we've underinvested in fossil fuels for years. In real terms, fossil fuel investment has been falling consistently, and particularly in the last 5 years, and it's going to go on fully. Now, that is not David Roach saying it's a great thing to invest in fossil fuels, because I believe that we are wrecking the planet. We've probably gone too far, but dealing with what investors care about and politicians care about, which is kind of very short-term champagne bar, belt and braces sort of intellectual quotients, they will go for the short term. And the short term actually is that because we didn't expand fossil fuel investment enough, we don't have the supply of fossil fuels we need. Our climate change policies, I totally agree with Greta Thunberg. They're a complete joke, and they're not going to get implemented in a way which makes any difference. So renewables will not plug the gap created by underinvestment in fossil fuels. So guess what? We're in for a squeeze, which will push up the price of traditional energy. The second factor which we need to pay attention to, and is not mentioned by many, but we've discussed it here, is the second greatest achievement of the Cold War was to provide the world with US-controlled cheap energy. That is over. And before I explain to you why it's over, let me mention that the greatest achievement of the Cold War was actually to bankrupt the Soviet Union. Unfortunately, we didn't bankrupt it enough, and the various nasty kind of toadstools have grown out of the political leftovers. We now have to deal with them if we have the guts, or else we won't be around discussing the free price of oil for very much longer. But to get back to the main topic of my conversation, the deal in the Cold War was that the US provided unlimited tolerance, military aid, and I can go on, to hideous and heinous autocratic producers of oil. You can just take the whole Middle East and put it in one bag, but I can stretch that out to a lot of other places like Indonesia. But essentially the deal was, you could have your horrible governments, and we, as long as you give us cheap oil and pump more of it when we need it. And it is to be noted that that was highly important to the US being able to stabilize energy cycles. Crises did occur, but many crises that could have been were ironed out using the Cold War agreements. And it also means that, of course, things can change. Well, things just have changed. The last time the US asked Saudi Arabia to pump more oil, the Saudi Arabians told the US to go and hump it. And instead of that, they met with President Xi Jinping of China, who, surprise, surprise, traveled to Riyadh to meet SMA. Normally, all other world leaders go to Beijing to kowtow to the emperor. Not this time around. The emperor got on the plane, or the sampan, as the case may be. Now, they signed 36 agreements, and just to give you an idea of what this new regime entails, in terms of transparency, none of those agreements have been open to public scrutiny or even revealed in a headline format to the world. But this is a highly significant event, as we've discussed before. What it means is that going forward, with the fragmentation of the world, which is, of course, Russia and China on one side, and liberal democracies on the other side, and a bunch of self-interested emerging and submerging markets making up the third side, which we call N. N is the factor of disintegration caused by these countries, which are normally ruled by elected dictators, unelected dictators, and have very poor institutional frameworks. Normally, these countries were kind of kept in order within either a bipolar world order or a single unipolar world order. Now they're not. They're out there buzzing around in space like recalcitrant subatomic particles. They will disrupt. For example, Saudi Arabia will sell its oil in large quantities to China and will become much more important to China, certainly in economic terms, than Russia, though politically China will continue to back Russia. But the deal will be this: The deal will be Saudi Arabia will give China cheap oil. China will pay for this oil in renminbi, which replaces the US dollar and hits at US hegemony and exorbitant privilege in dozens of different ways. At the same time, China will trade and pay for this oil with armaments. Saudi Arabia isn't getting the arms or won't get the arms it needs from the US because the Cold War agreement is over. But it will get arms from China, and it doesn't want to get arms from Russia because obviously Russia is getting bad publicity, probably overly bad publicity for the quality of its arms in global export markets. So this is one dictatorship, a pretty rich one, talking to another dictatorship, which is highly in terms of those sort of economies, economically advanced country. And it's a new deal which actually points the way towards further political fragmentation. Now, what that does is it raises the likelihood that the oil price will be used to maximize revenue for supplier dictatorships, mainly OPEC, because OPEC knows that in the long term, oil will be replaced. So the way to get rich and the way to get powerful is to maximize the revenues, therefore the price of oil in the short term, and use that price to get lots and lots of guns, so that when anybody tries to tell you what to do about your domestic policies, like stoning people to death for minor crimes or stuff like that, or people tell you what to do in terms of your international policies in relation to Iran or Israel or Russia, you can tell them to sod off. That is a very important factor in the new world, so-called tripartite world order, but which is really 2 plus N, where N is the fragmentation deals being done on the basis of commodities, mainly for the moment, between autocracies on one side and autocracies on the other side, to mutually reinforce their grip on power and their economic ability to defend themselves. So that's another reason why oil prices will rise. The third reason is that the shale bonanza in the United States, which after all was what turned the United States into an oil exporter rather than an oil importer, and also was what allowed the United States to smooth out any OPEC cutbacks or supply defaults from traditional oil producers, or indeed embargoes, like that on Russia at the moment. What did you do? You actually boosted the oil price, went up a bit, and the free market made sure that this was transmitted into shale oil prices, and shale oil production jumped in short order. Very quick response time, cheap to do. Well, the bad news on shale oil is it isn't happening like that anymore. Not only are there shortages in terms of the technical labor and technical asset inputs that shale oil requires, but the type of shale oil being extracted is becoming increasingly rare and hard to get out of the ground. So shale oil is no longer a fast-track response to supply shortages, and the leverage which keeps the US as a surplus energy producer. It will remain so, but the big factor pushing it there, shale oil, will be a lesser factor in the future. And of course, it means that the global oil prices and global oil markets will have to balance out without the input of increased supply or less supply, as the case may be, from shale oil sector in the United States. So that's the third factor. The fourth factor is very important, and it's arcane. It is Putin. The bottom line is Putin is going to have to produce less. As you know, on February the 5th, the final European oil embargo on oil products, which includes diesel and all the stuff which is not directly liquid petroleum. The reality is that this is going to cut Russian oil demand quite significantly. Also, the caps which have put in place have been extremely successful. The caps have now reduced the price of Urals by nearly 40%. The discount to Brent is nearly 40%. And we are really not seeing anybody rushing in to buy euros, which they are legally entitled to do as long as the price is below the caps. So the demand for Russian oil already fell after the price caps were imposed, and the initial oil shipment embargo was imposed by the European Union. That is not the oil product embargo, which is just coming in. The initial production in Russia fell about 20%. Now it's no longer down 20%, but the prices are down and the production is still down, meaning that Russia is losing about 170 to 200 billion dollars a month in terms of oil production revenues to be able to fund the war. That won't stop it funding the war. It can print money, go to the central bank, corrupt its economy, move to a command economy, do all sorts of things which will enable it to continue the war at a long-term economic cost, of course, and hopefully a long-term political cost to Putin. But what it does tell you is that, contrary to current opinion, price caps pretty successful, embargoes pretty successful, and embargoes are about to get a lot more on the 5th of February. So if you add all that I've set up into some sort of quantitative measurement, you will find that Putin needs to find a way of selling his oil to other clients outside the G7 plus Australia embargo countries, and he needs to find a way of delivering it. It cannot be delivered across Russia to the Far Eastern pipelines because there aren't any. There is Far Eastern production, which is selling at a lower discount to Brent, but it really is not a huge part of the equation. The big part of the equation is that taken together, Putin is going to lose approximately 500,000 to 1.3 million barrels a day of demand for his oil. So how does he sell that? Well, the first thing you can say, he will have to sell it yet cheaper. The second thing you can say is that nobody is rushing to buy it, because even though Western liberal democracies and some not very liberal democracies are free now because the price of euros is below the cap price, are free to buy Russian oil, the indications are they're not doing so. They don't want to go through the paperwork. They don't want to be seen to be a supporter of Russian war crimes. And so even where they are legally entitled to buy Russian oil, they're not doing so at the moment. So what's going to happen when there's another minimum amount of, call it 500,000 to 1.3 million barrels of oil a day, which is popping out of Russian wells, difficult to turn off in the freezing winter because the wells will be damaged, and looking for a home. And the answer is that Russia, of course, has to find dark tankers. Dark tankers are not only the floating tubs, of which one blew up in Thailand this week, killing about, I think, about 20 people. Dark tankers are tankers belonging to rather nasty people who constantly re-register these tankers under new names and new construction dates with marine agencies in places like Barbados. All the sort of places which are known, reputed far and wide for the excellence of their institutional regimes and the close auditing of anything that goes on in the country, i.e. nothing. So we are going to see these tankers, and we are seeing these tankers swapping identities. And if you delve into some of the excellent research being published by the Lloyd's analysts, it's becoming increasingly frequent. Now, what Putin has to do is to find approximately another 200 to 300 of these tankers to get this oil we have been talking about as being surplus out of the country. That is not going to be easy for several reasons. These tankers have very low efficiency, very high cost per barrel of oil, and the likelihood is that with the euro's price down below 50, close to 40, Putin is not making any money out of this oil, so paying additional costs to put it in some half-sinking tub to kind of slow steam its way in a southerly direction out of the Baltic down to the China or India, that is not really easy to do. And for example, in the latest month of available figures, dark tankers were the largest category of vessels calling at Baltic, Russian, and Far Eastern ports. They, of course, dwarf Russian tankers. They dwarf traditional shipping. So Putin has been very busy finding himself tubs, dark tankers to put his oil on. I think he'll be very pushed to find enough to take care of the surplus oil, which is going to come out of Russian wells starting around the middle of February. What that actually means is very important for our forecast of oil price, because it may seem to you like, well, you know, if he's in trouble and the oil is not getting out and it's so on, being bought at cheap prices, oil prices should go down globally. Well, that unfortunately is not correct. What actually happens is that Russia's supply is then withdrawn from world markets, which means that the people who were buying it, the countries which were buying it, have to go and find it someplace else, which is in the legitimate world market. If they do that, then it pushes up the demand while Russia is reducing the supply. And that is incredibly important when it comes to considering what is going to happen to oil prices. So I would say that Russia, having gone through that complicated rigmarole, and as you know, Russia is symbolized by little dolls with rather threatening faces, one inside another, another inside another, another inside another. So Russia, by its very symbolism, is a complex kind of Russian doll sort of place, and its oil tableau is no different. But the bottom line is not enough tankers and not enough clients, reduction in supply of Russian oil to global markets, higher global oil prices. Okay, now we come to the EU. The EU did not have an energy crisis in winter. As you know, the TFT prices are now down around 60 euro per megawatt hour. They were pushing 400 during the height of the anticipation of a winter crisis back in August, September, and then collapsed. They collapsed beyond what I said. I said they would go down to 150 as a stabilized price, justified by this and that, including costs. They are now at 60, which goes to show how much you should listen to me. But those prices are probably now at a bottom. But the most important and interesting thing about the European non-oil crisis is, how did it not occur? Well, let's do some very simple arithmetic, and this will make what I said about Russia look extremely, extremely complicated. Russia reduced its shipments to Europe by just under 100 billion cubic meters a day. So call it 96, which is actually the right figure. So that's the reduction in the gas that we got from Russia during last year. At the same time, this was compensated for by two things. Number one is a fall in the demand for gas, because European industry went into a recession. Manufacturing industry in particular went into a recession, so they needed less gas. Number two, there was an improvement in efficiency. So every widget or motor car being produced needed a little less energy to produce it than the previous year. And number three is the good burghers of Europe, like myself, actually are keeping the temperatures in their houses down low. We are being good in the main, civilians, but of course we have been inspired by the fact that we've had the mildest winter ever in the northern part of Europe, and we are keeping the temperatures low, which is why I am dressed up in about 5 layers talking to you in my virtually unheated office. All of those factors reduce demand for gas by about 42 BCM. So Russia cut supply 96. Those three factors, recession, efficiency, and good burghership, reduced demand by 42. And then comes the really interesting point. About 45 BCM was due to increased supply from imported LNG, liquefied natural gas, where the number of terminals is rising exponentially, both planned and executed. So essentially what happened was that Europe exited its domestic gas market, where Germany, thanks to Angela Merkel and the other Russian stooges in Germany, where we were totally dependent on Russian gas. We exited that market almost for 50% of all of the improvement, and therefore of all of the non-occurrence of the European great natural gas crisis in winter, which didn't happen. 50% of the reason why we didn't get that was because of LNG, and 50% of it was because we used less gas, less demand. Now, there are a few bits and pieces on the side, like increased imports from both Norway and the UK of LNG and other gas to Europe. That is only about 10 BCM. So broadly put, the gas crisis in Europe, us all freezing to death as the propagandists in the darkened rooms of Russian studios tell us has been happening, the shivering and chattering of European Union teeth, did not happen for half of the reason is because we use less of that stuff. And half of the reason is because we use more LNG. Now, why that is significant for global prices is very simple. It is because if China recovers, and I don't mean that China secularly recovers, I mean it shows higher growth, people are not locked down, people who are not forbidden from moving about will move about, they will take the train and the plane and some form of transport that uses energy, and Chinese energy demand will go through the roof, while its economy is actually not fixed. But of course, it will be cheered on by the economists and analysts who are paid to cheer it on and not look in detail at the reality which underlies any change in the statistics. The key thing is, if China does require more energy, it will require more LNG, and it will compete for that LNG in global markets. That is important because LNG is the only global gas market. All other global gas markets, whether it's the US or whether it's Europe, are actually domestic. They balance out based on supply and demand domestically. LNG is global. Europe has been able to fund itself or to find the gas it needed in LNG, global LNG markets last year because China was not competing. If China recovers and demands more LNG and its neighbors demand more LNG, then the competition for LNG will soar. LNG prices have fallen by about 50% from their peak, which occurred at about the same time as TTF prices. So in the very late summer, early autumn of last year. Next year will be a very different story because competition on the demand side for LNG is set to drive prices much higher, and that will knock on into prices for alternative fuels, which of course includes petroleum. So you have a derived factor which can drive global oil prices higher. Now, the final thing on the supply side I need to think about with you is Venezuela. There's a lot of discussion around as to whether the Biden administration will do a deal with the heinous, yet another nasty autocracy dictatorship of Maduro in Venezuela, and that this will result in Venezuela flooding global markets with its thick and rich crude, which would require a lot of changes in refinery capacity in order to be able to deal with it because of the nature of the oil itself. But it could be a factor in dragging down global oil prices. Well, we've looked at this pretty carefully. There is no doubt that Venezuela is a major potential oil producer because it has 300 billion barrels of reserves. So it could pump a lot of oil. when it was actually functioning, the oil industry in Venezuela was functioning, it was pumping approximately 2.5 million barrels a day. Its current figure varies between 650,000 barrels a day and 720,000 barrels a day. If American companies like Chevron, which are participants in Venezuela's oil industry, were allowed to participate and invest in improving oil output, it is possible that by 2024, Venezuela would be pumping something of the order at the top end of 740,000 barrels a day. So it would be an increase of 40 to 50,000 barrels a day. Now, given the size of what OPEC produces per day, we are looking at 0.0000, etc., of global oil production. So it is not Venezuela that is going to change what I'm telling you. And what I'm telling you is forget Venezuela. The Americans have even said that the only condition under which they will allow US corporations to participate in the revival, let's not call it a renaissance, of Venezuelan oil, is if this is done under a strict agreement that the additional oil production pays no revenues to the Maduro government. Now, that is that is about as likely to be agreed to as it is that you get snow in the Sahara in the month of August, because of course the Maduro government, being autocratic but not ideological, and lives on graft, corruption, and everything else. So they're not going to agree to let the Americans come in and save their oil industry on the condition that they don't get any money out of it. That's not going to happen. And if it does not happen, then Venezuela is going to be sending the odd tanker into global oil markets, but the amount of oil will be way below the figures I have actually talked about, which are way below the amount which would have any influence on global oil prices. So my bottom line is oil prices, they're going up. Oil stocks, very cheap. They are probably run by pretty hideous people. They have lied about climate change. They will go on lying about climate change, but they will make money. They have solid balance sheets. They have positive cash flows. They haven't really been investing. Therefore, the price of their output will rise. And I would say that on valuation terms, they pay dividend yields, which, roughly speaking, looking at a global cut of a sample of oil companies, they pay dividend yields of 4, and the PE ratios are around 4. So in a world where valuations are insane, and there is little economic analysis of why they are insane, it seems to me that oil itself and oil producers are okay as investments. In fact, they're rather good. But of course, you must bear in mind that by making those investments, you are condemning the world to become a black hole, which won't matter to me because I won't be there to actually see what happens when a septuagenarian falls into a black hole. But it might matter to your children who've had little children and who hope to leave them a better world. But if you don't invest in this, you will very probably leave them a better, poorer world. Bye.